Hello, welcome to the Thought Connected and another of our free webinars and seminars. Those who have listened into any of my sessions or listened to me at all would know the importance I place on governance, accounting, legal, insurance, etc. And to that end today, we have a great session for businesses on 10 crucial considerations from an accounting and taxation perspective. Today we have highly experienced accountant Matt Gordge with us. I'll give you a few details of Matt. Matt is a partner of RSM Australia Partners and a director of RSM Australia Proprietary Limited. Matt has over 15 years of experience providing business, taxation and superannuation services to small and medium family businesses and particularly individuals. This service has covered a broad range of industries, particularly expertise, includes transport, construction, hospitality, dealerships and health. Matthew seeks to develop a strong rapport with his clients to provide not only compliance and tax work, but business and planning advice. And it's something that I can attest to with the many years that Matt has been helping me personally and also with my business. Matt is a member of the Chartered Accountants Australia and New Zealand Association, and he has a Bachelor of Commerce from the University of Adelaide. Just as a reminder, before I get Matt to take over sharing the screen and start the presentation, that the information we give today is general information only, so please take your advice where necessary, and I know that Matt will be talking about that as we go. So welcome, Matt, and thank you very much for sharing your time today. I can give you permission now to take over the screen and take control of the meeting, mate. Thank you very much. Perfect.
Thank you, John, and thanks for the introduction and the opportunity to talk to the Thought Connect group today. I thought it was timely today to talk about 10 considerations for business that we see fairly commonly day to day with our clients, and 5 of those are around sort of fairly common tax planning or tax issues that we get asked regularly, particularly pertinent having just been through end of year tax time. And then I've come up with 5 areas to consider just from a business planning perspective, and things that it may be opportune to consider just to more effectively manage your business and get better information and also planning for your business. So we'll jump into the tax considerations. Before we do that, I will just reiterate that the advice today is more of a general commentary nature. It is critical that people seek their own advice, because circumstances will always vary, and business structures vary, and advice will depend on the type of business structure that you have or the amount of income that you earn. And the other point to that is we're in an environment where legislation's changing fairly rapidly, and government policy, and we may see that change even further if there's a change of government. So please do seek advice, take the points away from today, but then go and talk to your advisor to see how they apply to your situation. So first one, it's a really common deduction for both business and employees, but how best to claim your motor vehicle. Firstly, commercial vehicles like utes and vans, they're exempt from these rules, but if we're talking about normal cars, there's two ways to claim those. First one's the simplest and probably the most common method, which is to claim a reasonable estimate of the kilometres that you do for business, and apply that at the ATO rate of 66 cents a kilometre. You can claim up to 5,000 kilometres using that method. It doesn't require you to keep a logbook, but you do need to be able to justify how you did calculate the kilometres that you've claimed. For those people that are using their car more than 5,000 kilometres, or using it in a higher percentage of business use, a logbook method generally will be advantageous, particularly on an expensive or newer car. You have the opportunity with a logbook to claim all of your running costs, including depreciation and interest on any finance or lease payments. You do need to keep a logbook for 12 weeks. You need to do that every 5 years. And most importantly, keep all invoices because that is what is required by the ATO. So at least if you keep invoices during the year, you've got the opportunity to review at the end of the year which method is most advantageous for you to use. Secondly, home office. Again, really common issue for small business that don't operate out of dedicated business premises. Again, there's two methods to use there. The home office can be claimed on an hourly rate, which is 45 cents an hour. And in addition to that, you can claim actual expenses relating to IT, phone, stationery, or office equipment. That's probably the most common method. The other one is if you've got a dedicated place of business in your house where you have business meetings, where you are based in a dedicated space in your house, you can claim a percentage of all property costs. And they include power, water rates, and interest on any borrowings or rent. And that percentage is determined by the percentage of floor space that dedicated place of business represents. One little side consideration on that is if you do own your house and it is a place of business and you claim it that way, technically there will be a capital gains event when you sell the house, and there may be a capital gain for you to consider. Superannuation contributions, another really common issue. Probably the greatest way to plan taxation and accumulate wealth that we see legally. There are two types of contributions. There's a tax deductible or concessional contribution and a non-deductible or non-concessional contribution. You can choose how your contributions are treated, and they have different limits annually. So tax deductible contributions are now limited to $25,000 per year, and that's been reduced significantly in the last 10 years, as has the non-deductible amount, which is now $100,000 per year. And just on that tax deductible amount, with it being such a low amount of $25,000, you really have to think about over your lifetime your ability to make contributions. And with such a low maximum, the ability to make large contributions in a tax deductible in a small amount of years has been taken away. So it might be that where people traditionally contributed heavily once they reached age 50, you're just not going to be able to do that now. So people need to start planning their superannuation strategy earlier and younger. One thing to be aware of is a tax deductible superannuation contribution may be of little benefit to you from a tax planning point of view if you are in fact a low income earner, or you're in business and the business has ended up having a lower income year. Generally, you can contact your fund and ask them to change that contribution. If you're still relatively close to the end of the financial year. So that's another one to speak to your financial planner or accountant about Next one, entertainment. It's timely given the lead up to Christmas. A lot of people think entertainment is a business expense, which arguably it is, but I think because it is a business expense, they can write it off and use that as an excuse to go and entertain. However, generally entertainment is not deductible. And unfortunately that catches many scenarios and can even extend to having coffees or simple meals with clients outside of business premises. Further to that, if you do operate your business through a company or trust, there may be fringe benefits tax, and that FBT rate of tax is at the highest rate of tax. So just be aware of the tax implications before you plan to go out and spend money on entertainment and Christmas parties and all of your clients. One sort of sensible concession here is that sustenance on a work site is not entertainment. So if you're holding meetings, and sandwiches and coffees and the like won't be considered entertainment, and they will be tax deductible. The next one is a fairly heavily used concession that I'll call it temporary because it's being reviewed annually by the government, but it's the opportunity to write off as a tax deduction any items of equipment purchased for under $20,000. Ordinarily, they would need to be depreciated and written off over their useful life, but as long as they're under $20,000, you can look at outright deduction in the year of purchase. As I said, it's been a temporary measure that's been extended for the 2019 financial year, and it can be quite handy when it comes around to April, May, June, and you recognise that your taxable income might be a bit higher than what you expected, and you do need to replace some capital items that are under $20,000. So bear that one in mind when you're sitting down and planning for your 2019 tax. So there, some common issues that I think affect all businesses, and I sort of always run through those with my clients when I'm talking to them. And we like to, once we've looked at tax compliance, just touch base on a few pretty fundamental business 101 matters, and I'll go through them now. 5 common ones that I think are really critical for business people. First one is your operating structure. Often businesses can start out as sole traders, as people are sticking their toe in the water, or quite often they will start as a company or a discretionary trust. But regardless of how you've started, it is worth just reviewing and considering whether you've outgrown your legal structure. Primary considerations when looking at this issue are asset protection of your business and personal assets, what risk you have in your business, and also tax planning. Now, there are other issues like succession planning, but it's typically around asset protection and how it's going to be taxed. Obviously, before you enter into a new structure, it's important to get advice about whether that will trigger any tax events, but it's also really critical once you've done that to consider what needs to be changed with registrations for the business. So what do you need to do about your ABN? Do you need another bank account for a new company or trust? How does it affect your insurance? Is speak to your insurance broker or company about whether your insurance policy needs to be updated to reflect the change in structure, and also employer registrations with superannuation, return to work, ATO, tax file number declarations. The next one, always timely to review the registrations that you have for tax. Just to recap the basics there, GST registration turnover is gross revenue of $75,000 a year. Once you're going to exceed that, you need to register. And if you have made the jump to start employing someone, you need to ensure that you've registered with the ATO to withhold pay-as-you-go withholding. You need to be registered to pay employer superannuation, which is the 9.5% on gross wages. And in South Australia, you need to register with Return to Work, or Work Cover as it was known. And again, I've reiterated there about PI insurance. Does that need to be updated to reflect new scope of works or working relationships? So you might be joint venturing with another party to deliver a project, or offering new work that you haven't previously done. Are you covered for that in the event that there's a legal claim brought against you for negligence? Accounting software, typically these vary, but often small businesses, when they start, will start with fairly simple record keeping systems. We're fortunate these days where there are really good offerings of, I'll call them off the shelf, management, accounting and compliance software like MyOb and Xero and QuickBooks. The great benefit with them currently is that they're based in the cloud, and they allow digital downloads and sharing of your file with your accountant or staff members. And it's taken out a lot of the human data entry that's required. You can use bank feeds to make the task a lot easier, and in theory it should be much more correct too. I always think it's really critical to use these as business tools, not just a compliance tool that gives you GST numbers or to give to your accountant at the end of the year. So you should be using your management accounting software to firstly track your business performance, develop budgets, look at areas of strengths, areas of weakness, areas of underperformance, and also data around accounts receivable and accounts payable, to keep track of those, so you're not having to work out, has X, Y, or Z paid, and how come there's no money in the bank. They're pretty cost effective. Look, they vary from about $25 to $100 a month. Terms of engagement, this is something I'm not going to advise on substantially, other than to highlight how critical it is to have these and have them reviewed by a third party, experienced or qualified in this area. That may well be a lawyer. Really critical to avoid disputes with your clients and customers. Typically, some of the issues that need to be addressed, does it articulate the triggers to raise invoices? So, how do you progress invoice? Does it clearly list out and reference the services you provide and what you don't accept liability for? Again, really important when there's working partnerships or other parties involved. And an obvious one is make sure that the terms of engagement are accepted and ideally signed off by your client to avoid any confusion in the future. Another pretty critical area, albeit depends on the small business that you are in, but particularly for businesses that require capital expenditure or debt to purchase a business. It's really important to understand your financier and their offering and how that works, and whether there's a term involved or what reporting you'll need to provide to your bank. At the moment, post Royal Commission, it's fair to say that generally it's harder to borrow money at the moment. Banks certainly are lending still, but there is more scrutiny on the deals they're doing, and if there's an area that is a little bit outside of the box, it may well prevent you from getting further finance or getting finance in the first place. So don't assume that finance will be granted or that the bank will just blindly support you in meeting any requests that you have. Particularly around serviceability, that's probably the one that is critical, and you need to have earnings to show that you can clearly service any debt that you're asking the bank for. Just having equity isn't going to cut it enough at the moment. So also understand, how does a loan redraw work? If you are paying off extra capital, will you need to get approval, or is it available there to be drawn down automatically? Understand how a bank's going to look at any request for further finance, and what does your bank need to see to demonstrate your serviceability? You need to ask that question because it's critical, and that's something they will make assessment on in any application you make. And lastly, make sure you've got enough working capital in your business. So avoid that situation where you've hit your overdraft limit or you've run out of money and madly seeking or in a panic extra finance to make pays or to go out and pay a contractor or buy a piece of equipment. It's just not going to work. You're not going to get cooperation from your bank, and that's the last thing they want to see happening. And look, if you are in a situation where perhaps a bank is limited in their offering, just understand your other sources of finance or assets, and be clear about what capability or potential they have to help you. That's my presentation for today. If there are any questions, I'd be more than happy to answer them. I'd suggest to either direct them back through John, or John can provide my details so we can get those questions answered. As I said, everyone's circumstances are different, and hopefully today there's been a few points there that might have provoked some thinking and a takeaway to take back to an accountant or financial planner or lawyer or insurance broker to help you in your business. So I'd like to thank John again for the opportunity, and I'll sign it off from there. I'll hand it back to you, John.
Thanks very much, Matt. That was fantastic. Some really, really good points to consider. A couple of final thoughts from myself. It's really important to review the experience of your accountant. It's very easy to start a business with a tax expert or somebody who does your personal tax, but now's the time to really consider whether you've got the professional experience and the professional support behind you. Cheap is really expensive if you don't get it right. We will have a copy of Matt's details at the end of the video for you to either contact Matt direct, or you can get in contact with me via my details off of my website. Thanks very much for dialing in, and until the next time we have a webinar or a seminar, good luck and good business. See you later.